Eric became a national figure for his book, The Lean Startup, which sold 1 million copies, gave us words, actually is responsible for popularizing the phrase pivot, which...
Sorry about that.
But as Alan, and by the way, I recommend that everyone go read Adam Lashinsky's feature story on Eric, which ran earlier this year. It's really great. It's really a wonderful story. But we're not here to talk about startups. We're here to talk about Eric's new venture. He has basically stopped, he's limiting his new consulting clients to really focus on this, and it's called the Long-Term Stock Exchange. So Eric, why don't you just spell out what is it and how and why did you come to this?
Yeah, thank you, and thank you for having me here. If you read The Lean Startup all the way to the last page, and I know many people did not, it's okay. But if you get all the way to the last page...
Who read it, by the way? Who read The Lean Startup? Show of hands.
Oh,
okay.
Thank you.
Startup Way is out there for everyone also.
Oh, yeah, right. So, the best part about being an author is you get to have a last chapter where you suggest all the things that somebody should do something about. So, somebody should fix education, and also, by the way, how we teach entrepreneurship to MBA students. Anyway, I have a whole bunch of things I thought somebody should fix, and short-termism was on that list. Common thing to suggest that somebody should fix. And so I had floated this as an idea that somebody should build a long-term stock exchange on the theory that if companies are distracted from their fundamental job of serving customers, then they're less valuable. Which I know seems kind of dumb to even have to say it out loud, but it seems very straightforward to me. If they're less valuable, then that's not good for investors either. So then why do we have all this short-term pressure? It never made sense to me. So I suggested, hey, we need to create a new institution that can regulate the behavior of managers and investors at the same time to create a new social contract around long-term incentives and alignment. And that sounds to me like a stock exchange. So someone should create a long-term stock exchange, or LTSE. That's as much as I had thought about it. Or really I did not even know what a stock exchange was at that time. That was just an idea that I put out into the world, and then my work here is done. Somebody else will be in charge of solving this problem. And then it just was one of those ideas that would not leave me alone in the intervening years. And eventually I decided that I should at least learn enough about capital markets and the financial system to learn why it's a bad idea. It was very polarizing. Even early manuscript readers of The Lean Startup, I remember one person wrote and said, this is such a bad idea, you have to take it out of the manuscript because you are flushing all the hard-earned credibility you built up in the preceding 399 pages and just throwing it away at the end. Investors will never go for that. Oh, they had a whole list of reasons why it's just a terrible idea, most of which came down to companies just have to do what we say. Okay, that's just how it is. And so it just never seemed right to me. I was like, I don't understand why we run the financial system the way that we do. So I spent, this is now, book came out in 2011, so I've been working on this for a long time. Learned enough to know that the system we have today was not designed by some master planner who said, hey, what would be the best possible corporate governance system for companies to serve their customers in the best way possible and therefore investors to make the most money possible. We have stumbled our way into the system through a whole bunch of changes over the years. And if you track the changes over time, every change, there was a logic to it. It made sense at the time. You could understand what everyone was thinking. And yet, cumulatively, they've put us in a position that I think our grandparents would find pretty bizarre.
Well, Tim Cook last night said if he were king for a day, he would flush away quarterly earnings, basically. So I think a lot of people agree. I mean, we just did a whole session on how this short-termism is really
That's brutal.
Yeah, and so, but at the same time, I think there are a lot of people who think this will never work. You can't turn this whole machine around and change the rules like this. So what do you say to those critics?
Well, I'm used to doing the impossible, so I don't mind. I don't take it as an insult. And it's taken a long time to figure out how it works. But there's a fundamental change in what stock exchanges do that has made this reform possible. This is now 15 or 20 years old, but it used to be that you would list on a single exchange and then the trading would happen on that exchange. But in the US for quite a while, we've had what's called the national market system. So stocks trade freely across all exchanges, which means it's possible to bring a new exchange to market without compromising the liquidity that companies that are listed on that exchange would have. And exchanges have this very important, I would say, quasi-governmental role in regulating corporate governance, but they don't use that power to do the things that we all know companies ought to do to be right for the long term. So our idea is to enact new listing standards that simultaneously affect how managers and investors behave for better mutual engagement, mutual alignment of incentives.
So what are those rules? What are the...
So and again, you got to look at this as a series of interlocking parts because it's a new social contract. It has to work simultaneously for every stakeholder. We like to joke with our investors, oh, this is just your old typical five-sided marketplace problem. No problem. One value prop to work for companies and VCs and the buy side and the sell side and regulators simultaneously. So it's like five-dimensional chess to make the pieces work together, but that's why it's taken 7 years to figure it out. So for example, your voting power as a shareholder should be proportional to how long you've held the stock. So there's nothing wrong with saying you're going to buy in and out. You can day trade the stock if you want, but someone who day trades should not have the same corporate governance responsibility as someone who's been a shareholder for 10 years. So we have a system that allows you to do that. The company should know in real time who their shareholders are. And I don't mean the street name, I mean the beneficial owner of the security. Because you have to know if your share price is down 10% today, well, if that's because one or more of your major long-term shareholders has abandoned the company, that's a very significant event. But imagine that you knew for sure that 0 long-term investors had sold a single share of stock. The fact that your stock price is down 10% is not even news. Nothing happened. So your employees have to know the difference between those two situations. So we have a system that allows that to happen. We combine that with a number of executive compensation reforms around more long-term comp, because if this was a room full of asset managers, you can imagine their concerns would be slightly different than the ones that we have been talking about so far, so we did that for them. And then we have a different and better disclosure regime that is layered on top of GAAP reconciliation. You still have to do quarterly reporting. That's an SEC rule. We can't do anything about that. But we eliminate quarterly guidance, so you can't play the beat and raise game. We have better data disclosure for educating analysts about what the actual long-term prospects of the company are. This is tied into my own work with Lean Startup and what we call innovation accounting. That is, how do you publish leading indicators that give investors education about future growth? And then a whole grab bag of board and multi-stakeholder reforms that people have been talking about forever, but never doing anything about. So we kind of package those together into one package of reforms. Companies that adopt these standards can get the LTSE stamp of approval, and that's a binding commitment that investors can rely on because it's quite difficult to unwind once you commit to do it.
And you have raised a significant amount of money for this from the likes of Andreessen Horowitz and others.
Yeah.
You also, along the way, made a little bit of a pivot of your own, which was you were originally going to do this as a separate exchange, and now you are partnering with IEX, which is the exchange made famous in the book Flash Boys,
Yeah.
designed to counteract moves of impact of high-frequency traders. But talk about that strategy and why that is the one you went with.
Yeah, I mean, it's your classic minimum viable product. We wanted to get to market sooner, and so whenever possible to reuse existing capacity and infrastructure seemed logical. And then we had such a high degree of philosophical alignment with IEX as their fellow disruptors to the financial services industry. You can imagine they have very similar ideas about long-termism that we do. It just seemed like a natural fit to start by basically reusing their platform for our initial customers, while we in parallel simultaneously pursue a brand new platform that we'll bring to market once we get regulatory approval.
And that's what you're waiting for. You're waiting for the green light to then go out and start soliciting companies.
Yeah, that's right. We have been engaged with policymakers and the SEC for several years now, and very, very optimistic that we can start operations this year.
So who's your ideal first listing?
Well, I'm not legally allowed to speculate, nor am I legally allowed to solicit anybody, but I've had a number of very interesting informational meetings with companies that are in this next generation. And what's amazing to me is most founders and CEOs, CFOs that I talk to of private companies, they think this is too good to be true. So I don't have to convince them that this is a good thing that they would want. I have to convince them that it's actually possible to reform the system in any way. Because we, in Silicon Valley especially, we talk about ourselves as such disruptors and everything's new and we like to reinvent everything. And then you're like, but the very specific financial instrument by which we all make our money has to be done this exact specific way, and any deviation is impossible because the mysterious they would never allow it. So it's actually been interesting to me to learn about not just how the financial system works, but how the kind of the hidden assumptions behind how Silicon Valley works too. And this is one of these projects that's kind of split across San Francisco, New York, and DC, and we all gotta, just for once, hold hands and work together for mutual benefit instead of just, what we usually do.
So we're gonna go to questions in a minute or two, and I'm sure people here have some questions about this. But in the meantime, so some of the critics of this idea will point out things like, doesn't this overly insulate executives from shareholders?
Yeah, well, not compared to the Facebook system. So we think that's, you gotta pick your point of comparison. Listen, we had in the Wall Street Journal, when they wrote about this, an anonymous hedge fund manager called it disgusting. That's pretty good. Uh, yeah, there's a set of people who do not believe that companies should be run for the long term, and therefore this insulates management. Like the idea that this insulates management from that kind of pressure, like that's by design. That's what it does. Now, to call that insulation rather than deliberation, I think is just propaganda. And we all know this because, like, we understand politically that to build a republic, you have to differentiate between tourists and the citizens of the republic. And it's not to say that tourism is bad. Tourism is very economically important, but it ain't the same as being a citizen. And, like, everyone understands that. So even the hedge fund people understand that. They just would prefer that we talk about something else.
And then some say that it'll devalue, favoring long-term investors might devalue companies relative to others.
So I think I've made this clear, but listing with us has no liquidity penalty. So the key to this is you have to promise a CEO, if you list your company on this exchange, you'll have access to the exact same level of liquidity that you would have. Otherwise, the technical and legal infrastructure that is required to do that is quite intricate, so we're taking us a long time to get it right. Believe me, I spent a lot of years telling CEOs that they would have mostly the same liquidity and as a conventional IPO, and they're like, mostly? So not the same. Like 99% the same? Like, so not the same. So no, it has to be exactly the same, so we guarantee that. And then anyone who, beyond liquidity concern, anyone who really thinks that running a company for the long term will make it less valuable has told you a lot about their philosophy of company building. So I feel it's kind of like a self-refuting question.
Who's got a question for Eric? Alan.
Eric, you make it sound almost too good.
I know, that's my problem.
Yeah. So what in your view is going to be the biggest gating factor? What's going to stop adoption by companies who are clearly philosophically aligned with you?
You remember that old saying that no one ever got fired for buying IBM? I mean, that hasn't been true for a long time, but it's like an old expression that still survives. No disrespect to IBM intended. Not a friends over there. That's, I think, the inherent conservatism in the financial markets is always our biggest enemy. People, when push comes to shove, are they really, really, really willing to try something new? And what's interesting to me is Silicon Valley is especially, and the technology industry generally, is very herd-oriented. We follow the leader. We do what the last company did. So in the early days, that's a big question. It's like, can we convince people that the herd should move in this new direction? Of course, we view that as a real positive. Once we establish a new standard that we're all going to do together, then that should have its own self-sustaining element to it. So I think that, I almost feel kind of silly being in a conference like this and be like, our biggest challenge is, will anybody buy our product? But that's kind of, I think that's a very familiar situation that a lot of people have been in before. So yeah, at the end of the day, once we have the legal authority to sell it, we'll find out.
You're like your startup clients now. So
yeah, it's almost like I've thought about this a few times.
Over here, yeah. Hey, Mark.
Two quick questions. One is, I don't understand how you can guarantee equivalent liquidity, so I'm curious to understand that. And secondly, Larry Fink has been very outspoken about a number of principles that you referenced.
Yes, very grateful.
Maybe not exactly aligned, but last time I checked, BlackRock is, I don't know, top 1, 2, 3 holders of equity securities in the world.
Yeah.
Have you talked to Larry about getting his endorsement for this idea so that that actually links to my first question, which is, are you going to have institutional investors who actually are engaged in this?
Yeah, I don't want to talk about Larry by name, so we'll just talk about institutional investors in general. Have been extremely favorable about this, and I've been having to kind of ask people to take my word for it for a long time, but we just went through a public comment period at the SEC, so you go check the Federal Register. By the way, everything I've said so far is backed up by like hundreds of pages of legal filings that if you need a sleep aid, you're welcome to read. I'm not making stuff up here. This is I have to have detailed justification for every claim I make in public now under penalty of what. So you can read the filings and you can read the comment letters, and some of the world's largest asset managers like CalPERS, folks like Glass Lewis, a bunch of academics, obviously all a huge who's who of Silicon Valley folks all wrote comment letters in support of the idea, which you can hear it in their own words. Larry did not write a comment letter for us, but it's Larry. So. But the other question was, how do we guarantee liquidity? It sounds too good to be true, but actually it's a mechanical rule that is enforced by the SEC that no exchange can deny listing of trading of any other exchange's securities. Think of it like, imagine if the net neutrality rule was not just that everyone has to do this, but everyone has an affirmative obligation to prove that you are fair in the way that you handle other people's stock. And because of what's called the best quote rule, not only do you have to trade other people's securities, if another exchange has a better price than you can offer, you have to route the security there. So liquidity is guaranteed by law. If you comply with the national market system rule, that's the hard part.
Another question, anyone? Yeah.
Hi, I'm Barbara Humpton, CEO of Siemens US. And what I'd like to do is have you take us into a boardroom once this is up and running and give us your picture of how the boardroom operates.
Sure, I'd be happy to. So the first thing that's different is we require that every board have a product and strategy committee of the board. Because if you notice that certain companies, their boards become all about comp and audit, and it's all lawyers. And I love lawyers. Lawyers are wonderful people. Many of my best friends are lawyers, but if nobody's watching the long-term product and strategy, then that's the problem. So that's a requirement to have that. The second change is, I'll give it to you by example of a company I was talking to recently, a board member of a big media company. And they were talking to me, this was 2 years ago maybe. They were saying, we've finally decided to make the transition to digital. And I had to keep a straight face and be like, just now, you guys have decided that the future is digital. They're like, yes, we finally decided. And I was like, what took you so long? Like, what? And they're like, I know. You're embarrassed about it. Like, of course, this has been obvious for a long time, but we didn't know whether our investors would support us in making this dramatic change or not. And I was kind of like, well, you think your investors are all idiots? And they're like, no. We understand their point of view. It's, some of them bought into this company because we're a printing company. So we're an industrial, make trees turn into paper. Like that, they understood it in a certain way. And if we make this change, maybe they even agree that this is a necessary change, but do they really want to be with us on this journey? And it wasn't so much that their investors had told them not to do it. It's that they fundamentally didn't know what their investors actually wanted to do. So like if you really buy into the idea that companies exist to serve their shareholders, which I think that's a dubious idea to begin with, but even if you buy into just that idea all by itself, it still leaves over the question of like which shareholders and over what time horizon. And it's just they didn't have the information. They paid a lot of money for what's called stock surveillance, which I think is a wonderful euphemism. But they still couldn't figure out who their investors were and what they wanted, and so they were just paralyzed. So that would be different. You would know in real time who those people are. You could then go talk to those people and understand what it is they want. Remember, Reg FD controls what you tell them, but they can say anything they want to you. You can listen to anybody that you want. You're allowed to do that.
But getting back to the board, a CEO has to pitch this and get his or her board.
Oh, to be convinced to do this.
Well, I don't think that was the question, but I mean,
sure.
This has to be sold to the board before anything can happen.
That's right.
So,
Listen, in order for a company to do this, board has to be totally bought into it. And I would think the other difference, we didn't get to this, but one of the responsibilities of the long-term strategy and product committee is to publish an annual framework of leading indicators of future growth. The details matter here a lot. I know people are very nervous about the liability that will be caused if you make predictions or promises about future growth. This is not that. This is simply saying, here's how we would like investors to hold us accountable for whether our strategy is working or not. And the key thing is that for an investor, what happens with companies most of the time is they promise them this awesome strategy with this awesome growth, and then time passes and then the stock price is the same and the growth is the same. Like nothing happened. They did the strategy, and the investor doesn't know fundamentally, is it because the strategy, which seemed like a good idea to us too, was incompetently executed? Or was it just a bad strategy and we need a new one? Well, if it was incompetently executed, you need to be out of that stock because this management team has a problem. Or you need an activist campaign to make some. But if the problem was we both thought it was a good idea to take our product to China or whatever, and then it turned out that that's not a good market for our product, but it seemed like then actually that's a great moment to have learned something new and plot a new strategy, not to get overly lean startup about it, but that's what the pivot is all about. So actually being able to have that conversation in true dialogue with your investors, I think is also a much more productive strategy conversation that boards can't have today.
Why can't a company just adopt these rules and principles on their own without listing on a new?
Show of hands, anyone want to do that? Yeah. It's really difficult to ask individual companies to tackle this problem on their own. We think there's huge benefit in A, developing a standard and having a class of companies do it all at the same time. B, in going to investors. Like, have you ever tried to get investors to give you credit for some really good corporate governance thing that you're doing? and you're like, I think my stock price should be higher now because we've adopted, well, I don't want to name any other reforms, but you pick your favorite one. And investor, I've talked to, probably 1,000 asset managers now in the course of doing this project. They all tell me the same thing. They're like, look, even if I agree that that's a good reform, anything a company can voluntarily adopt, it can voluntarily unadopt whenever it wants. And look, as much as we complain about investors, they got plenty of reciprocal complaints about us, and there's been bad actors on both sides. So I've met fund managers who are like, it's my job to receive the phone call from IR that says the CEO needs a new plane, so we're doing this one-time comp adjustment bonus nonsense thing because we can, and what are you going to do about it? And I couldn't make something like that up. I'm not creative enough for that. Like, those are real things that really happen. Fund managers are super angry about it. They feel like all these CEOs are out for themselves, blah, 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 and we all have our same set of complaints, right? So no, there's not enough trust to do this unilaterally. I think the only way it works is if companies make a binding commitment to something that we all agree is a standard that makes more sense than what we're doing before. That's why we do it this way.
Well, Eric, I think we're all going to be watching very closely what happens, and we
much.
wish you luck as you try to change this enormous system. Thank you for being with us today.
My pleasure. Thank you all so much. I appreciate it. Thank you. And thank you.